Hello, welcome to the final episode of Managerial Accounting. It is ironical that this chapter is called Chapter 11, but that's just a joke. In this chapter, we will learn to separate relevant and irrelevant costs in a decision making context. Please note that decision making makes sense only when you have more than one alternative out of which you can choose. In order to be relevant, a cost must have two features. One, it should pertain to the future. If it is a cost incurred in the past and will never be incurred again, then it is not relevant. Second, a cost must be different between alternatives in order to be relevant. If you have a choice between buying car A and car B and both cost exactly the same, then the cost of the car is not relevant in your decision to buy a car. Some other factor like fuel efficiency, brand name, or something else might be a deciding factor. In other words, two types of costs are always irrelevant in any decision. First, sunk costs. They are those costs that have already been incurred and cannot be reversed regardless of what you decide to do. Second, are future costs that do not differ between alternatives. Future costs that do not differ between alternatives are never relevant. There are many other names for relevant costs depending on the context. A differential cost is one that is different between two alternatives. Hence, it has to be relevant. An incremental cost is increase in cost over the current situation. Since incremental costs imply that costs will be different under the two alternatives, they are relevant costs too. Finally, avoidable costs are those costs that can be eliminated either completely or partially by choosing one alternative over the other. Since avoidable costs make the cost of two alternatives different, they are relevant costs too. If you are making a part currently and have the choice of buying it from an external supplier, all the costs of making it are avoidable costs, hence relevant to the decision. Let's make one point clear about fixed costs before we proceed, since this point will come up again and again. Most fixed costs are period costs, meaning belonging to a month or a year, and are generally allocated to different products or lines of business by some allocation rule. So if a line of business is closed, the fixed cost allocated to that line of business has to be borne by other remaining businesses. The point is that allocated fixed costs are not avoidable even if you close one branch office or stop making one of the many products. Since allocated fixed costs have to be borne whether you keep or drop the branch office, they are unavoidable costs and are therefore irrelevant. Please note that decision making in a business sense should have at one of the two criterion, either profit maximization or cost minimization. That is, choose an alternative that either increases company's income or, if not, at least reduces company's cost. Let us try to see the concept of relevant cost in action. Here, company is making a part at the cost of, let's see, $24 a unit, and they have the choice of buying it at $22 from another supplier. Plus $25,000 of fixed costs are avoidable. Before you begin the problem, look at all the costs and see which ones will be avoidable if we buy the part instead of making it. You should be able to see that direct material, direct labor, variable overhead plus $25,000 of fixed costs can be avoided. All these costs are relevant numbers. Now, let's look at the questions. First question, what are the relevant costs for Mo? Easy. All the variable costs, which means $1 of direct material plus direct labor plus variable overhead times the number of units in question, are all relevant costs, plus the $25,000 of fixed cost, which is going to be avoided if the decision to buy the part is taken. Second question wants you to compare the two alternatives. Since we are not given any revenues, we can only compare the cost of the two alternatives. Let us see, what is the cost to buy from the supplier? Remember, we are paying $22 a piece to buy the goods. So 5,000 times 22, 110,000 will be the cost to buy. Now, what is the cost to make? Be careful here. 1 plus 10 plus 5, which is the variable cost, times 5,000 plus 25,000 is what is the cost of buying it. What happened to the other fixed cost of making it? Remember, the rest of the fixed cost remains whether you decide to buy or you decide to make. Since that number appears in both the columns, it is an irrelevant number and we just dropped it out. I hope that was clear. So the company is better off making the product rather than buying it by $5,000. There are two different ways of solving decision-making problems. Under the total approach, you make an income statement for each alternative and compare the income to decide which alternative is better and by how much. This is a slightly longer approach but is easier. The differential approach looks at only those numbers that differ between the alternatives and arrives at the same decision as the total approach. This approach is shorter and is based on the idea of isolating all the relevant costs. This approach is also good in situations where all the information needed to prepare an income statement is not available for both the alternatives. So please go with whichever method you are more comfortable with. Let's look at some popular decision-making problems. One is where a company receives a one-time special order that is not part of a company's normal business and company has to decide whether to accept or reject the special order. Typically, a company can accept a special order only if they have extra capacity, like labor time or machine hours available. In such cases, only the incremental cost of making the additional unit is relevant. Since total fixed manufacturing costs will not change because the special order is still within the company's relevant range, fixed manufacturing costs are typically not relevant since they have to be incurred whether or not you accept the special order. So here we have a problem where the company has a plant capacity of 200,000 units. You are given some costs and then you are told that the company is currently selling 190,000 units, which means they are well within capacity. Q Incorporated has contacted this company about purchasing 2,000 units at $24 a unit. Current sales will not be affected by this order. The question is, what is the company's change in operating profit if the one-time only special order is accepted? So think about it. You have a choice between continuing to make the product or buy it from, you have the choice between accepting the special order or not accepting the special order. So think about it. If you accept the special order, what would happen? You would be you would be supplying it at $24 a unit. What is your cost of making it? Look at it. Your direct material, direct labor, variable overhead, and variable fixed cost. All these costs will be incurred on a per unit basis in making the product. That gives us 16.60. So if the company decides to accept the special order, they will receive $24 a unit, but they would be spending 16.60 for 2,000 units. This would give them a $14,800 increase in their income. Think about both the fixed costs, the fixed overhead as well as the marketing fixed costs. We did not take that into consideration because both these are fixed costs and are not going to change whether we accept the special order or not. Are you with me? Let's take a look at another typical decision. Companies are constantly faced with the question of whether to make a product locally or outsource it. The decision should depend on which decision is cheaper. Typically, a company's current fixed costs are unavoidable even if company decides to buy the part rather than making it. So be careful about how much of fixed costs can be avoided if you decide to buy it. Sometimes the decision to buy a part rather than making it is also attached to the decision of what to do with the space or labor or machines that are now spare because we are not making the part. So if the company has an alternative use of the capacity that just got freed, this would be an opportunity cost for continuing to make the part. So opportunity cost is the cost of next best alternative, a benefit that must be foregone as a result of using the plant to make the product rather than buying it. Let us see this concept in action. So here we have a company that produces a part. The company is currently making 10,000 units. Direct material, labor, variable, and some other fixed costs are given. You are also told that of the total fixed factory overheads, $60,000 out of 140,000 is avoidable. So, if the company decides to buy the 10,000 units at $36 a unit, as you are told, they can avoid direct material, direct labor, variable overhead, but not all of the fixed costs. Only 60,000 of the fixed cost can be avoided. So total cost that would be avoided will be 340,000. If you divide it by 10,000 units, you will get $34 a unit. But the cost incurred to buy it is $36 a unit. So the company is going to be better off by making it by $2 a unit, whatever the number of the units may be. Here we have the same problem as on the previous slide, just part 2 of the same problem. Part 2 says assume no other use of the facilities. The highest price that the company would be willing to pay for 10,000 units of the part. You just solved in part 1 that the company makes $340,000 total. So that is the maximum amount of money company would be willing to pay. That is $34 a unit and no more. Easy. Another typical decision in a business involves a product line or a customer or a branch office that is not making a profit, and management wants to decide if it should be retained or dropped. On the surface, this seems like a simple decision. Add or drop a segment if net income is going to go up, but be careful about allocated fixed costs. If a company makes 4 products and divides the factory rent equally, then closing down one product is not going to reduce the total rent. It will just be reallocated to the remaining products. In other words, allocated fixed cost may always be an unavoidable cost. Here, we are given a company that's currently selling 6,000 units at $15 each. You are given some variable and some fixed costs. The company is trying to decide whether or not to discontinue the manufacture and sale of this product called toffee. The question tells you that all the manufacturing costs are going to remain even if this product is dropped. First thing to notice in this problem is that the company is currently losing $18,000 a year. Let's see. The question is, if they drop the product, will they be better off or not? So let us list all the revenues and costs that will go away if we drop the product. So sales revenue and all variable costs and all fixed costs of advertising this particular product as well as the salary of the manager will go away. But revenue of $90,000 is higher than the avoidable cost of $88,000, meaning that we will lose the $2,000 contribution margin or segment margin as we call it that we are currently earning if we drop the product. So we would be better off keeping the product rather than dropping it. Part 2 of the question says, well, this question has a little tricky wording. It says that people will buy other products if this one is gone from the shelves and the sale of other product lines will increase. So if total contribution margin from other products is going to increase by $12,000, it may not be a good idea to continue to make toffee because it brings us only $2,000 additional of contribution margin. The question wants to know the required unit sales of toffee to make the company indifferent between dropping and not dropping the toffee line. Note that company's current contribution margin from toffee is $90,000 of sales revenue minus $66,000 of variable cost, that is $24,000. If you divide it by the number of units of 6,000, you will get $4 a unit. If the company dropped this product, they will lose $2,000, but they will gain $12,000 from sale in other products. So net loss will be $10,000 of contribution margin, which should be made up by additional sale of 10,000 divided by $4 of contribution margin equal to 2,500 more units. Since the company currently sells 6,000 units, they will have to sell a total of 2,500 plus 6,000 equal to 8,500 units of toffee to be indifferent between keeping and dropping the product line. If toffee cannot sell at least 8,500 units, then the company is better off dropping it rather than keeping it. Many decisions in companies are restricted or constrained by a resource. For example, a store may have limited shelf space and would like to sell only those products that take very little space on the shelf. Or a company may have only limited labor or machine hours and would like to make only those products that are made in a very little time. Or if you sell pizzas and have only one delivery car, then you would like to deliver only to close by places. I think you get the point. In such cases, the decision is to find the most profitable use of the constrained resource and also to calculate the value of buying or borrowing more of that resource. For example, if I can rent a car to deliver additional pizzas because my single car is not going to be able to handle all the deliveries on a particular day, then what is the maximum per day rent that I would be able to pay? Let's look at an example. So here the company makes three different products, X, Y, and Z. You are given the selling price, the variable costs, and some fixed costs. Question A says, for each model, compute the contribution margin per unit. That part should be easy. You take the price, you subtract the variable costs, and you get the contribution margin per unit. For part B, it needs to know what is the contribution margin per machine hour. In order to calculate the contribution margin per machine hour, we will see what we need to do. We take the time required by each model and divide our contribution margin per unit to get that. Okay, let's try to solve these questions one by one. The contribution margin per unit for XYZ is sales price minus all the variable costs. So 60, 70, and 80 for the three products respectively. Next question is about the contribution margin per machine hour. For this, you take the contribution margin per unit that you have calculated in part A I mean, and divide it by the time required by each unit. So 1 machine hour for X, 2 machine hours for Y, and 2 machine hours for Z. So that gives us contribution margin per machine hour 60, 35, and 40 for the three products. Question C says, if there is excess capacity, which model is most profitable to produce? Remember, excess capacity means no constraint, which means the company should be free to produce the product that gives them the maximum contribution margin per unit. So the choice in part C should be Z, which gives you the maximum contribution margin per unit of $80. Remember, the question is saying there is excess capacity, meaning no constraint. So be careful about this one. Finally, part D says if there is a machine breakdown, meaning machine hours are constrained, then what would be the most profitable product? Since breakdown means we need contribution margin per machine hour, we would choose most profitable product per machine hour. So for part D, we will choose X, since contribution margin per machine hour is $60 for model X and lower for the two other products. Done. A final decision example is when companies want to update an old equipment, computers or vans or security systems, and they want to know the cost of replacing the old equipment with the new one. Please note that costs incurred before today, meaning when you are taking the decision, are all sunk costs and cannot be relevant to your current decision. So the fact that you bought the car 2 years ago at some X dollars cannot be relevant to your decision today, because if you continue to drive it, you will write depreciation off in maybe 10 years. But if you decide to buy a new one today, you will write it off right now. But in either case, it will be written off. The only relevant number is what you can get from selling this car right now versus what it will cost to buy the new one. Let us try an example. So RV company is considering replacing a machine. You are given a whole bunch of data regarding the old machine and the new machine. The first question says, what are the sunk costs? Remember, all costs which are incurred before today are sunk costs. So original cost, accumulated depreciation, and book value would all be considered sunk costs. Next question is about the relevant cost of keeping the old machine, meaning what will it cost me, excuse me, What will it cost me to keep the machine for the next 5 years? That would be just the operating cost. Please note that the disposal value of the old machine is relevant for buying the new machine, but not for keeping the old machine, because if you are thinking of keeping the old machine, then you can't be thinking of selling it off at the same time. You will sell it only when you consider buying the new machine. For the third question, we need to figure out the cost of each machine over 5 years. For the new machine, it is the net purchase price and the cost of operating it for 5 years. What is net purchase price? Net purchase price is the cost of new machine minus the sale value of the old machine, and then we have the cost of operating it for 5 years. For the old machine, it is just yearly cost of operation. So it looks like it is too expensive to replace the machine because the company will lose $24,000 over the next 5 years. I hope that problem is clear. That is it for now. Once again, please remember that for this chapter, fixed costs are usually unavoidable, and in a constrained situation, it is always better to sell a light product like candy than bricks. Good night.